Shell looks to offer investors some huge dividend growth over the next few years. It is currently offering a 3.6% yield, but we would be expecting this yield on cost to be double digits over the next few years. Currently, it is up around 15 to 16% year to date in line with the S&P 500, and we can see it is towards the upper end of that 52-week range. But in today's episode, we want to understand, is Shell PLC a buy, and consider those incredible future dividend growth that we will expect from this company. We're going to take a look at Shell PLC today. We're going to run through their income statement, looking at their revenues year on year, that growth, as well as that bottom line, that net income. In turn, we're going to take a look at the health check of the balance sheet, taking a snapshot view of their total cash versus total debt. This in turn is going to lead us to that all-important dividend safety score and some very important financial metrics you need to understand before investing in Shell PLC. And as always, we will run it through our stock valuation model, getting to our intrinsic value and therefore our acceptable buy price given our investor margin of safety. Now, it is up around 15-16% in line with the S&P towards the 52-week high and with a nice starting yield of 3.6%. Now, what we want to understand is, what price is this a buy, and take a look at the operational efficiency of the business as well as some very important financial metrics. Now, top line growth, we can see 2018 revenue was around 388 billion, and what we like to see is around 3 to 7% growth year on year. December 2022, their latest annual report, around 381 billion. So in fact, we can see a decrease over the last 5 years. And at a more granular level, we can see, in fact, it has been decreasing from 2018 all the way down to 2020. You can justify some of that to COVID, but it has had an enormous effect on the top line. And then from 2020, on a more positive note, we can see some strong growth on the top line over the following years. Now, in terms of the bottom line, how was that affected? The net income, well, 23 billion in 2018. 2022, that bottom line around 42 billion. So almost double the bottom line growth over the last 5 years. Again, on a more granular level, it does interestingly follow that top line revenue, where we see a decrease on the bottom line in 2018 all the way to 2020. We can see that COVID year, negative 21, so essentially a 21 million loss on the bottom line. But then it does pick up again in 21 and again in 22. So it does interestingly follow the top line, as we do see companies that are inconsistent, but this seems to be consistent in that approach. But also we can see from that COVID year, it has then picked up. So we want to understand what we should be expecting over the next few years. Now, a snapshot of the balance sheet to check the health score. Well, total cash versus total debt. 2018, around 27 billion worth of cash sitting on the balance sheet. Latest quarterly report, around 45 billion. So they are holding a significant amount more of cash over the last 5 years. And when we compare that numerically and directionally to the total debt, what we see here, in fact, is total debt 76 billion in 2018 and an increase, in fact, to 84 billion in their latest quarterly report. So they are not only holding significantly more cash, but they are holding some more debt on that balance sheet. So interestingly, this will affect that dividend safety. And what we can see right now is a dividend safety score of 45, making that dividend borderline safe, and we'll touch upon some metrics to understand that fully. Currently, the market cap around 212 billion, making a mega cap company. Now, some metrics for those that believe we're heading into a recession. Recession dividend, so they maintained the dividend in 07-09, they didn't increase it, they didn't decrease it. Recession sales, negative 43%, which is incredible. And if you can see here, it's below the average growth during the 07-09, with companies in the S&P 500 during that period also having negative growth, but not as high as we see here for Shell. Recession return, however, interestingly, was negative 40%. It did beat the S&P 500, which had a negative 55% from 07-09. But again, do bear that in mind, that is quite a large negative return. Now, in terms of dividend growth, they have been paying dividend growth streaks for 2 years consecutively. Now, their latest increase a few months ago at 15%, double digits we love to see. But when we look over the last 5 years and over the last 20 years, it is negative growth. So we want to understand, can we expect to see those strong, large double-digit dividend growths we like to see for the foreseeable future? And at a bare minimum, what I always say, minimum, you want to be getting a 4% increase in your dividends, salary, and other income-producing assets, as the US inflation rate over the last 40 years was 4%. Anything less, you are taking a pay cut and losing your purchasing power. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. We see here the current yield at 4.09 versus 4.17. So we have our first signal, which shows, in my opinion, roughly reasonable valuation as it is in line. But again, as always, we will draw our conclusions towards the end of the episode and will never look at any models in isolation. Forward PE 8.8 versus 9.2. Again, another sign of reasonable valuation. We can see the sector PE significantly higher than that of SHEL, and right there towards the 52-week high. However, as I always say, 52-week high does not signal overvaluation. Likewise, 52-week low does not signal undervaluation. Now, regular viewers of the channel know that we tend to ignore the earnings payout, focus on the free cash flow, as earnings is susceptible to manipulation by management through their accounting. So what we tend to look at is the free cash flow, but the data's here for those who like to look at that. Now, what we can see, personally, I prefer 60% and below, as I believe it is the sweet spot for essential companies to offer those double-digit dividend growth. Now, we can see it's fairly inconsistent. We can see some years of incredible payout ratios, as we can see in 2013, 2015. Basically, what this is signaling when it's more than 100%, so in 2017, is essentially saying that 104% of the company's free cash flow was paid out as dividends. So they are essentially paying out more in dividends than they did generate in free cash flow in that year. From 2017 onwards, it has been a bit more stable. We can see higher than 60% in 2019, but over the last 3 years, it has been below 60%. So that is positive to see, but again, something to bear in mind and keep an eye on, given of how high it has been in the past. We then move on to the free cash flow per share. Again, it is my preference to look at this data over the EPS, but it is there for investors who like that data or as well. 7 cents in 2013, 6.24 in 2022. It is going in the right direction, so that is positive to see. Fairly inconsistent, and as we can see, 2023, it is expected to be lower at 3.71. You could argue this industry as a whole is cyclical, and therefore it is expected to be increases and decreases. And we can see that here very, very clearly. Whilst we like 3 to 7% growth year on year, we can see the cyclicality nature of the business. Negative growth for a few years, followed by positive, followed by negative, followed by positive, and so on. Numerically speaking, 451 billion of sales in 2013, 381 in 2022. And as we can see, it has the decreases and then the increases. So fairly inconsistent. So do bear that in mind. Again, another sign of inconsistency with their shares outstanding. Whilst we love it when companies do share buybacks, returning excess cash to shareholders, what we can see here is they do the opposite, where they issue shares, diluting your position as a shareholder. And then again, from 2018, they have started to do share buybacks. So again, fairly inconsistent. But over the last 10 years, the moral is that over 2013, they started with less amount of shares than they did in 2022 outstanding. So again, bear that in mind. ROIC, one of my 7 golden dividend metrics. Check the pinned YouTube video to see the other 6. I like to see 10% plus. The reason being is 10% gives me faith that management are able to effectively allocate that capital. What we can see here for the large part is that it hasn't really hit that 10%. But again, it's inconsistent and cyclical, as we can see throughout the whole analysis. Again, likewise, the same method or the same conclusions from the operating and free cash flow margin. Whilst we like 12% plus for the operating margin, it rarely ever hits that. And with the free cash flow margin, from 2017 onwards, it has hit that target that we'd like to see. Now, one of the most important metrics, the net debt to earnings for interest, tax, depreciation, amortization, with 1.5 being our preference, which signals the number of years it would take the company to pay off their debt net of cash on hand. For the large part, in fact, it has been below that, with 2022 being 0.67 years and 2023 expected to be slightly higher at 0.8, still below that 1.5, which does give me faith in that dividend being safe based on the metrics analysis we've seen so far. And on the right, this is purely showing us the percentage of a company's financing from debt as opposed to equity, with 2022 being 23%. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe, and hit the bell if you want to be continually notified of these stock review videos delivered to your doorstep. And as always, if you want to run your own companies through the valuation model to get to your own intrinsic value and acceptable buy price for your own companies on your watch list and portfolio, grab a copy in the pinned description below. So we start off with Graham's valuation. We have our stock ticker SHEL, the earnings per share at 8.22, with the growth rate per analyst estimates at 3, and that yield on AAA corporate bonds at 5.2. This gives an intrinsic value for SHEL at $70. Now, when we take a look, we can see there's some nice upside to the current trading price at around 10%, showing some signs of undervaluation in the current market. We then move to the multiples valuation model. Companies in a similar sector and size, I'm sure you've heard of them all, Beyond Petroleum, Chevron, ExxonMobil. We have their stock price, earnings per share, and PE multiple. We get the average multiplied by the earnings per share of SHEL to get a multiples valuation price of $72. Again, some nice upside to the current trading price, around 15%, again showing signs of undervaluation. We then move on to the third model, the dividend discount model. Now, the reason why we see these negative growths here is the dividends are paid out in GBP, pound sterling, and therefore with the FX rate, it will affect these rates. Average growth rate around -2%. Again, this does factor in the FX. So when we go back and we take a look at the essential dividend growth, it's been negative 11%. Now, forward looking, I am expecting them to do higher growth rate, 6.5%. We did see that latest increase in July at 15%. So I am hoping this to go up. I've gone for 6.5%. Again, as always, with your own analysis and estimates, if you do want to justify higher or lower, grab a copy of the model in the pinned description below and run your own figures through. However, based on this, we get a DDM price of $74, again showing some nice upside to the current share price between 15 to 20%. We then move on to the final model, the discounted cash flow model, where we have our free cash flows year on year, with the average growth rate at 587%. Forward-looking analysts are expecting a decline in the growth rate around 10%, and including our discount rate, we get the present value of future free cash flows and terminal value. Add them together with the cash, subtract total debt, and we get to our equity value. Divide that by the shares outstanding, gives a DCF price of $94, showing some very strong upside to the current trading price, around 50% and higher than the 52-week high seen not too long ago. Now we get to the intrinsic value, which is the average of the models we have just run through. And as always, if value is being provided, you're loving the content, smash that like button and hit subscribe to join the lovely community. Intrinsic value is coming to around $77. Again, nice upside to the current trading price and above that 52-week high. Now, current price is sitting at around $65. Now, margin of safety, typically I'd go for a 10% if it had a wide moat, strong financial metrics, good forward-looking data. Again, with SHEL, with a recession looming, you could argue it is going lower, or you could argue it's going higher if you have your own reasons and investment thesis for it. Now, 10% again isn't what I would use for a company like SHEL, but those who would, your acceptable buy price would be around $69, $70. 15%, your acceptable buy price would be between $65 to $66. And if you're looking for 20%, your margin of safety, your acceptable buy price would be around $62. Now, personally, I do feel around $62, it is looking like a buy. However, again, I know people on this channel who want to be more conservative. 25%, you're looking at around $58. Now, Wall Street are forecasting the price over the next 12 months hit around $74. Again, they also believe there's some nice upside around 20% to the current trading price. But as always, let me know your thoughts in the comments below. Are you looking to buy? Are you looking to sell SHEL, or purely on the sidelines speculating? As always, if you want to grab a copy of the model to get your own intrinsic value of this company or any of others in your portfolio, click on the pinned description below. Have a great day. Catch you on the next episode and take care.